Hello, welcome to the March Economy Watch. This month we'll be talking about two of the most salient issues of the day, COVID-19 and the U.S. elections. Hi, everybody. Welcome back. As I mentioned at the start of the program, this week's Economy Watch will feature a discussion of COVID-19 and its impact on the U.S. economy, as well as the U.S. economy in the upcoming U.S. presidential elections. So some of the key questions that we're going to be asking today include how large of an impact will COVID-19 have on the U.S. economy this year? How might U.S. economic performance influence voters over the coming months? What are the candidates' economic priorities for 2021 and beyond? And what economic imperatives should the next U.S. administration focus on? Before we dive into the material, just a quick reminder, you can get CPE credits for your participation today. Please enter your name into the bottom right of your screen. Click on the three pop-ups that occur over the course of the live webcast and make sure you stay on for the entire time. I want to introduce some of the other speakers as well today. I'm joined here in the studio by Ottoman Özildirim, who is the Senior Director for Economic Research and the Global Research Chair. Welcome, Ottoman.
Thanks, Eric. Good to be here.
Great. Also, we're joined by Devin O'Connor with the Committee for Economic Development. He is the Deputy Director of Economic Research. Welcome, Devin.
Thanks, Eric. Glad to
And then finally, last but certainly not least, Joseph Minarek, Senior Vice President and Director of Research at the Committee for Economic Development. Welcome, Joe.
Hey, Eric.
Great. So we're going to dive right in and discuss the U.S. economic outlook, which my colleagues and I have been working on for the last week or so. A lot of moving parts, but we think we have a pretty good a handle on where we are at the moment. But before we dive into those numbers, we actually have an audience poll. So we'd like to get your input on what you think the U.S. economy is likely to do over the course of the year. Can we pull that poll up, please? All right, so the COVID-19 virus is spreading in the U.S. Based on what you know of the virus, how do you expect the outbreak to play out? It'll peak in April, followed by a gradual slowdown in the number of new cases. It'll be an extended period of an outbreak continuing into May and June. And number three, we are in for an extended outbreak that will climb all year. The poll question that I originally referenced is actually coming up a bit later in the webcast. So let's go ahead and lock those results in if we can. So it looks like about a third of you expect a peak in April, followed by a gradual slowdown in the number of new cases. About two-thirds expect the outbreak to continue into May into June and then to slow over the summer. And only about 5% expect that it's going to be an extended outbreak. I think maybe from our perspective, internally, we've been talking about sort of a peak number of cases in April or so. So this is maybe a little bit more sort of pessimistic than I had thought. But there's a lot of unknowns at this point, so it's certainly a reasonable expectations. Ottoman, do you have any comments?
It's really not too surprising. I think in a way it reflects the uncertainty, what we don't know about this outbreak. We are kind of taking the flu season as a guide, and the little information and the research being done on that is yielding some early results that maybe this is going to run its course over the next few months. But a greater degree of precision about April or May or June, it's still hard to say.
Yeah. Devin, any thoughts?
No, I mean, I'd leave this question up to the epidemiologists. I don't think I could add anything in terms of what it's going to do. But I think the height of uncertainty around it is the important piece in keeping in the sort of low confidence with which you can say just about anything at this point about the trajectory, especially because it depends so much on what ends up being the reaction, and what we don't know about the disease to date will matter as well. So I think keeping a posture of just being open to a lot of wide variance in what could happen is the right way to go.
Joe Minerick, anything?
Well, we don't know if it's really seasonal. That will have a big impact. We are still in the early stages of the mission, so that probably leads us to think that maybe it'll go on a little longer, even if it is seasonal. But who knows? We've just got to behave and keep our fingers crossed.
And wash our hands.
And wash our hands before we cross our fingers.
Okay, well, let's go ahead and dive in then to what our thinking is for the U.S. economy presently and sort of looking forward. So we started the year off on pretty strong footing, 2019 into 2020. The job markets were still strong. We saw some improvement in manufacturing PMIs. Consumption was still holding up fairly well, as was consumer confidence. But of course, this outbreak really throws a wrench into the gears of the economy. So COVID-19, it's here, it's spreading. As I think we've already touched on a little bit, the key question here is sort of when do we hit this peak, and to what extent does the associated fear that comes along with this sort of peak as well? Because in many ways, it's the fear that has the greater economic impact, especially on the consumer. The U.S. LEI for January was was positive. The 6-month growth rate was positive as well. That was consistent with about a 2% GDP growth. So another indication of sort of the trajectory we were on before all this started. Consumption also a little bit softer in January, but which was trending well. But we really expect consumption to take somewhat of a hit over the coming months. Manufacturing as well, as I mentioned. Manufacturing PMIs were up in January, a little bit down in February, but still positive. But if you look at value-added output from manufacturing, that was also improving. It wasn't as negative as it has been on a year-on-year basis. So that was trending upwards. However, demand shock in terms of consumption and also a supply shock in terms of global value chains could potentially disrupt that activity as well. Monetary policy. We, I think, started the year not really expecting to see much movement. The Conference Board didn't actually forecast any changes to monetary policy this year. And then, of course, once the market started to really slide, we saw the Fed step in with a 50 basis point cut about a week ago or so. I think last Monday it was. And from our perspective, I think at this point we're expecting about another 50 basis points of easing in the second quarter. Equities, as I'm sure all of you have been watching, have been doing quite poorly. We've actually looked at historic shocks for the S&P 500 and tried to sort of trace out what this looks like compared to 9/11, compared to Lehman's collapse, compared to SARS and MERS. And the current pathway looks a little more like Lehman than the other ones. That having been said, once you're on that path, that doesn't mean that you can't get back off of it again. So we're trending in that direction, but I think there's some room for possible improvement. Fixed income, bonds, a real flight to safety. We've seen the 10-year yield drop down below 1%. So yeah, a lot of different moving parts here, most of which are not very reassuring. That having been said, our newest U.S. economic forecast does have a contraction for U.S. GDP growth in the second quarter, but we do not expect a recession. for the year. We still expect about 1.4% growth for the entire year, and a large jump back, or bounce back, I should say, in the second half. So that's a sort of a quick overview of what we're thinking. We'll dive into the numbers and some of these individual components over the next 20 minutes or so before we pivot and head over to the presidential side of things. Why don't we talk a little bit about the LEI? Ottoman, do you want to step in here for a second and walk us through this?
Sure. This is probably a chart that our viewers are familiar with. The LEI is a barometer of future economic conditions in the business cycle. It's a high-frequency indicator that is made up of lots of different aspects of economic activity. And it really looks at the U.S. economy at the national level. So, beyond individual sectors, let's look at the overall economy, the aggregate economy, and see what the momentum is and if there is a direction of change coming. And the blue line shows the growth rate of the LEI. We like to look at it in conjunction with another index called the Coincident Economic Index, which is a measure of current economic indicators. So LEI will move up or down ahead of the coincident indicators. Together, they weren't really suggesting a major signal of conditions deteriorating in 2020. In fact, there was even an early indication that the industrial down cycle that we had been in was going to give way to a turnaround, and all of the other indicators were pretty consistent with that. Very early indications of improving outlook.
Mm-hmm. And was consistent with about a 2% growth rate. That's sort of what we had expected
exactly
in January or so.
So we didn't see any imminent signals of recession, and overall these indicators were consistent with about that 2% growth rate. However, the COVID-19 outbreak kind of throws a wrench in this story, right? Yeah. So the underlying conditions are that 2% growth rate, about trend. Mm-hmm. However, when a shock like this occurs, the indicators will take a hit. Mm-hmm. None of that is yet apparent, whether you look at the leading indicators or the coincident indicators or the consumer confidence. Mm-hmm. So all of those numbers are going to come out in the next couple of months, and we'll begin to see how the real economy is being affected by the shock. The only exception is probably the financial markets, where we are seeing a lot more volatility and reaction that's being fed by the uncertainty and the nervousness of what happens to the outlook. Mm-hmm.
One of the other interesting things I think to point out is the U.S. is sort of moving into this period of volatility and uncertainty from a position of strength. The U.S. economy was doing fairly well, growing at about trend when this hit. It's a lot better to walk into this kind of a storm in that kind of a situation than the reverse. If you look at China, for instance, the sort of fundamental trends of Chinese economic growth were slowing. And so, that slowing growth pattern coupled with this major outbreak really puts, I think, a lot more stress on the Chinese economy and how they sort of come out of this storm than it does the U.S. economy. So I think that they're probably in for a rougher ride than the U.S. is.
Right, that's a good point because we've looked at similar shocks in our indicators before, and generally what you see that when an economic shock hits, whether it's a natural disaster or something like this outbreak or an earthquake, there's a very sudden impact, and then the underlying trend of the economy eventually reasserts itself over the next several months. Mm-hmm. But in this case, we don't know, how long it's going to last, mm-hmm. and how deep that impact will be. So there are two kinds of uncertainty there that the financial markets are reacting to. Sure. But given that we're entering the year on a solid footing, that would suggest the underlying strength. There is some underlying strength in the trend. Mm-hmm. So just putting things in context, sure. without downplaying the importance of the outbreak.
No, thank you. That's that kind of context I think is really important right now as people sort of grapple with this. There's so much on the news, people watching the markets minute by minute. But take a step back for a moment and say we were in a pretty good position sort of walking into this. Speaking of good positions, I thought I'd touch briefly on the U.S. consumer spending. As we already mentioned a few slides ago, great spending in 2019. Really, the majority of U.S. economic growth actually came from the consumer last year. But walking into this, we have some trepidations. For instance, travel, tourism, and entertainment, which are all industries that consumers spend quite a bit of money on, account for about 7% of U.S. GDP. Those are also some of the sectors that are going to be the most damaged by this outbreak. So we did some modeling on this and played with the size of the contraction that we expected over a 3-month period. And we're expecting that sliver of travel, tourism, and entertainment to decline quite a bit. And that, of course, is going to drag down overall PCE growth. So I don't have the exact number in front of me, but I think we're projecting about a negative 1.7% in real consumer spending in the second quarter, which is going to be the primary drag on overall real GDP growth. Why don't we pivot and talk a little bit about manufacturing for a second, Ottoman? Do you want to
Sure.
walk us through that?
So, while consumers are softening and perhaps will show more weakness, we had been expecting, as I mentioned, the manufacturing turnaround. And here you see one of those manufacturing indicators from the Purchasing Managers Survey, which had been dropping off into contraction territory. That's the green line. But it did reflect a pickup over 50, which is the threshold for contraction. However, the latest numbers in February kind of show a pullback, right? So we'll probably start to see the outlook be affected by what's happening in the supply chain, the inability to get parts from China and other places globally. So that's one of the reasons for the underlying nervousness. Let's look at the non-manufacturing part of the economy, which is more services dominated. The black line has always been in expansion territory, but going forward, we might also expect some softening there too, because the sectors that you mentioned are all in either consumer services or B2B services. They will probably show more weaknesses over the next few months.
And then, of course, the Fed cut 50 basis points. Usually these cuts come in 25 basis point increments. So they really doubled down, which should, to a certain extent, help manufacturers and other businesses in terms of financing and things like that. As I mentioned earlier on, we do anticipate the Fed to move again sometime in the second quarter with some additional support. But as you can see on this chart, we're already seeing the Fed action have an impact on a variety of yields, whether it's mortgages or the Treasury or corporate bonds. How is this going to impact consumers, borrowers, businesses, things like that?
So the Fed easing makes financial conditions more accommodative. It makes liquidity available. And it takes off the pressure on banks also because they would see their margins falling as the long interest rates fall, the long yields on those 10-year Treasury bonds fall, their margins come under pressure. So the Fed is kind of pulling back and releasing that pressure that the banking sector is feeling. And the more accommodative environment makes it easier for firms to find financing and funding their various activities, and it's also partly a psychological move, right? It was really surprising because the Fed almost always moves when they have a meeting, and it's kind of on a regular schedule. This came ahead of the meeting, and it was kind of built as a confidence building measure, and so that should help with companies planning to spend. It also helps home buyers because mortgage rates have started to come down, and already we were seeing an improvement in the housing construction sector. But
the question there is if demand is going to be able to sort of step in. You have lower interest rates. Certainly we'll see probably a lot of refinancing activity. But in terms of whether this actually manifests itself to consumers going out and buying new houses, They feel there's uncertainty and there's a bit of fear, so it's hard to know.
Well, the uncertainty certainly holds people back from making large purchases, even if the interest rates are favorable. But at the same time, there may be some consumers who are not able to go out and do their shopping, right, or house hunting, because of the conditions related to the outbreak.
So we're going to just touch really briefly. Ottoman mentioned the Fed cut and the expectations that the markets would react favorably, and they did maybe for half a trading day or so, and then that evaporated. So we've really seen a hit to U.S. equities, and then of course over the last few days, equities have been, shaken even more by this sort of fight between Russia and Saudi Arabia in terms of oil production, and we've seen the price of crude really drop pretty starkly. We actually put out a chart on the U.S. equity movements really since let's see here, since February 17th. We just published this yesterday, trying to compare movements in the S&P 500 with other shocks that we've seen really over the last 20 years. So we look at 9/11, we look at Lehman, SARS, and MERS, and the parallel is pretty pronounced at this point in terms of the severity of this. It looks a lot more like a Lehman kind of event than a 9/11 or certainly a SARS. That having been said, people make the argument that U.S. equities were already overvalued and that we were overdue for some sort of a correction. So you have to factor that into the equation. And then, I think it's also important to note that just because we're on this path currently doesn't mean we're going to stay on it. So there is the real possibility that tomorrow or the next day we could start to see it rebound and it sort of gets off that pathway that looks so ugly, that orange line.
I think one thing is certain, that we're going to see more volatility in financial markets, especially stock markets.
That's probably true, given the fact that cases are likely to continue to go up and anxieties are likely to intensify over the coming weeks. It's hard to know to what extent the markets have baked this into the prices. There's so many things that are happening, but I don't want the viewer to be too pessimistic. Just because this is the track that we're on right now doesn't mean that it's the track that we're going to stay on. But we have another poll question, the original one that I had mentioned about the U.S. economy and how it's going to perform this year. Can we pull that poll question up, please? Second poll question, please. Oh, there we go. How large of an impact do you expect COVID-19 to have on U.S. economic growth in 2020? Growth will be stronger than in 2019. Growth will be about on par with 2019, between 2 and 2.5%. Growth will come down to 1 to 2%. Growth will come in 0 to 1, or the U.S. economy will contract for the entire year, not just for a quarter, but for the entire year of 2020. Let's take a look at the polls. I think we're getting close. Let's go ahead and maybe lock that one down. All right, so about 37% of you think 1 to 2%, but almost an equal number think 0 to 1. I think maybe we hope we didn't bias them because we already told them what our projections were going to be. But this is actually maybe a little bit more pessimistic than we've actually been here at the conference board. Ottoman, any thoughts?
Well, it's not really too different from what I was thinking. I think the risks are tilted to the downside. Yeah. It really is uncertain to what extent the outbreak will be with us, and so I think a lot of the projections are going to be changing pretty rapidly.
Devin, anything?
No, only that I think the distribution is about right between the different answers. If you sort of take those as the probabilities that we're going to do worse than last year and much worse than last year and maybe even extremely worse, then I think that's the right way to be thinking.
Joe, anything from your perspective?
Just to note that given that the outbreak is international in nature, it's interrupting supply chains. It is possible that we are going to see the economic hit develop over a period of time. There may be a bounce back at the end. There will be a bounce back at the end, but How much of a hit it takes on the U.S. economy, of course, is the big question.
Yeah,
but it's-
I go ahead.
Sorry, but it is hard to estimate how much of a bounce back you would get. I think that's really clouding the transparency of the outlook here, because a lot of the contraction is in services type activities, and some of those are not going to come back.
Yeah. So if
and-
you skip a movie next month, you're not going to go necessarily see two movies
Exactly.
a month after that. That's a good point. I would like to know who this one individual who said it's going to be stronger. I'd love to have coffee with them. I think that'd probably make me feel better about everything.
Yeah, it's good to be
We'll
optimistic.
reach out, whoever you are. So why don't we do just a quick overview, because we want to get to the material on the U.S. elections. This is a snapshot on a quarterly basis of what our expectations are for U.S. economic growth this year. We have that contraction of about 1% in the second quarter. Again, that is largely driven by a contraction in real consumer spending. That having been said, assuming that the pattern that we've already discussed with you in terms of the outbreak sort of peaking in April and May and then dissipating over the summer, assuming that holds, we're expecting a real strong bounce back in the second half of the year as the consumer feels more confident, buys some of these maybe durable goods that they hadn't, doesn't go see two movies maybe necessarily, but there will be some sort of pent up demand, hopefully that is unleashed in the third and the fourth quarter.
Yeah. So you see a V shape here,
Yes.
which is encouraging for the time being, and maybe we should also note that we're already starting to get news out of China that things are starting to normalize, and I think some numbers that I saw was that 60 to 70% of their workforce was employed in production during the height of the outbreak, but now it's expected to kind of go back up to about 80%, right? So their capacity is building back up. So some of these ripple effects are going to go through the global economy, but hopefully will be lessening.
Yeah, no, I've read, I think that there was a statement made by the Politburo that they expect full employment by mid-April. So, it follows with that trend that you were just describing. And of course, once you hit full employment, the supply chains, which are heavily concentrated in China, can start to mend, and components can start flowing between factories and overseas as well.
Yeah.
So hopefully that's sort of the trend and the direction that we're moving in.
Yeah, but one of the other uncertainties in the outlook is that how much stimulus this Chinese government is going to provide.
So the word on that is that most people are not expecting the same kind of stimulus that we saw during the financial crisis, which is kind of a good thing and a bad thing. The size of the stimulus in China actually kind of resulted in a bit of a hangover for the Chinese economy. They grappled with a lot of non-performing loans, a lot of debt at sort of the local government levels that they've been trying to process really for the last 10 years or so. So I think there's a certain amount of caution within China not to overdo it, because they know, based upon what happened a little over a decade ago, that there's a price to pay further down the road if you really dump tons of money into the economy. Yes.
Eric, I think there's one more point that's worth making about this, which is just whenever you have a shock, especially an unexpected one like this, it tends to also reveal sometimes other things that we weren't tracking that may have not been going so well in the economy, or other risks that we weren't thinking about. So I think the one last thing to consider in all of this is just the tail risk that when the shock hits, we find out something that we weren't paying attention to that poses a much more problematic experience for the economy on its way back. And so there is a little bit of tail risk in here that we just find out something wasn't working the way it should, or something was a little bit more risky in the underlying economy. And so that's the one little bit of tail risk. We don't know what all the channels exactly will be that we're dealing with as we proceed through this. So it's not just limited to the effects of the virus directly itself on the economy.
Yeah, I think that's a good point, and I think a good example of that is the stock market correction that we went through. Nobody really thought that the stock market would go down, but there was a sense that stocks were getting overvalued, right? So, given the trajectory of the growth that we were seeing, maybe stocks were overvalued and they were ready for a correction. And then this really exposed that risk, and the correction happened. And is there anything else out there that is imbalanced and could be exposed with what's going on?
No, that's a great point. And I think one of the things that I also want to impress on the audience is that, we do not forecast a recession. A one-off, one-quarter contraction in GDP is not a recession. And indeed, if you look at U.S. GDP growth really over the last decade since the financial crisis, we've had a number of quarters that have seen contractions. So it is not unprecedented. It is not a recession. It is a single quarter. That having been said, I think Devin brought up some great points, as did you, Ottoman. If there are other underlying factors of weakness in the U.S. economy, and this sort of pulls the rug out from underneath it, that's something that could have a longer term impact on growth.
Yeah, I mean, it's the nature of shocks to kind of blow over pretty quickly, but they can leave lasting sort of effects on the economy.
But we don't really. I mean, again, you don't know these things until they're revealed to you.
Exactly.
But based upon what we had been seeing in the U.S. economy, things seem to be quite robust, and the economy seemed to be, as we said, on a good footing. So I don't want to be too pessimistic. We don't expect this to happen, but it's certainly a possibility.
Yeah, I mean, just to put things in context, is that a recession really takes continuous, 6 months or longer a period of downward contracting economic activity in overall the aggregate economy, right? So we wouldn't really know if we're in a recession or not until that period has passed, and even then there'll still be a lot of debate about whether we're in a recession or not. So sure. You want to see contraction. You don't want to, but you will see a contraction of in employment, in industrial production, in personal incomes over 6 months or longer before you really kind of describe a recessionary period. Otherwise, it's as you said, a one-quarter contraction.
Well, while we're on the topic of sort of downside risks to the U.S. economy, we do have a slide here that outlined, what could sort of make things worse. But before we dive into those individual sort of touch points that could make things worse than we expect. There's a quote from Robert Shiller. He was on CNBC yesterday. He said that what we have now is really two epidemics. We have an epidemic of the coronavirus, but also an epidemic of fear based around a narrative that is not necessarily keeping up with scientific reality. And this narrative has been quite striking. So in some ways, I think what he's saying is, there is a reason to be afraid, but, fear is sort of the real enemy in some ways. Any thoughts on? I thought this was quite profound. I don't know if you guys feel the same way or not.
Excuse me. Yeah, well, I mean, that's one of the reasons we keep tracking things like consumer confidence and CEO confidence, just to read the pulse of what the level of optimism or sentiment around the economy is from those parts, and a loss of confidence, an environment of fear, obviously affects people's decisions. Mm-hmm. But we have to wonder, how much of it is rational, based on facts, and how much of it is based on things like herd behavior and things that are not really related to the underlying real trends that we're seeing.
Sure. So let's go ahead.
I think Schiller's point really does make the point that irrational behavior can change what rational behavior is. If you think about it, it takes a while for a factory to shut down a production line. It takes very little time for a panicked investor to call his broker. And changes in financial markets, which change people's wealth, will then change their consumption behavior. Changes in consumption behavior will change investment decisions, may change employment. That's part of the reason why fear is such an important element in the current outlook.
Great comment, Joe. Absolutely. Let's just quickly go through some of these points. Top risk, downside risk to the forecast that we're releasing today. Of course, COVID-19, a more prolonged outbreak than what we built into the model. Consumer confidence, a further deterioration of consumer confidence beyond what we already expect. It could be quite troublesome given that the U.S. economy is about 70% driven by the U.S. consumer. Business confidence, another one. Business investment in 2019, especially in the second half, had been contracting. Negative year-over-year or seasonally adjusted annualized growth in second, third, and fourth quarter. We'd expected that to emerge originally coming into this year, in January when we were sitting around. But more trepidation among business executives could make them push off those kinds of investments even longer. Manufacturing activity, as Ottoman mentioned earlier in the program, supply chains around the world are being disrupted. A prolonged disruption, which is not what we forecast. We expect, April or so for China to come back online fully. But if that doesn't happen, a further disruption, supply side disruption, can shock manufacturers. And then one of the other big ones, and we haven't been hearing this, and we're not really overly concerned about it at this point, given how strong the labor markets have been. But that's layoffs. Most companies, I think, are quite reticent to let go of their workers, given how difficult it has been to attract them. But in the event where this is something that really goes on and on for a number of months, they may be in financial positions where they don't really have a choice, and that really has a spillover effect in terms of consumer confidence and consumption as well. So if you want to have a look at the more granular nitty-gritty of our forecast, make sure to take a look at the slide number 17 after the program. We're not going to go through it now because I feel I don't want to cut into our guests' time. I want to get pivot at this point over to the presidential elections and the U.S. economy. And we're going to launch this portion of the program off with a poll question. Can we please pull that poll question up? So, what do you think will be the most important economic issues during the presidential election campaign in the fall? Healthcare, debt, jobs, taxes, trade, or inequality, or other? A lot of options, so we'll give you a few minutes to wrestle with them.
And I guess those people that are responding other could type in their comments.
Yeah, I wish they could as well.
If they want to share what they're thinking.
Let's go ahead and lock that down then. So it looks like we have about a little over a third of the audience is looking at healthcare as a primary issue. That shouldn't be, I think, too surprising given what we've been seeing on the campaign trail. Followed by inequality. And then tied for third, debt, jobs, taxes, and trade. And then some mysterious other issues, which I wish we could capture in this kind of a poll. So I'm not terribly surprised by this, given what I've been seeing in the debates and how sort of large an issue this has been on the campaign trail. But I kind of want to hear what maybe Devin and Joe think. Devin, do you have any thoughts on the results of the poll?
Yeah, I think the idea that healthcare is going to be a major issue in the election is probably spot on. First, just as an economic issue, healthcare is such a large part of the economy. It's about 1/6. Spending on healthcare is about 1/6 of the total GDP. So that already is sort of going to make it a really salient issue. And then second, no one seems to be completely satisfied with the status quo. And so both in terms of the Republican and Democratic side, you have people proposing pretty large-scale changes to the existing system. If you look at the Republicans, Trump the president ran on the idea of coming in and replacing the existing Affordable Care Act healthcare system with something that he described as better and more coverage and cheaper, and articulated a lot of frustrations with the existing system. And what we've seen is the Republicans over time have been focused on the idea of what has been called repeal and replace. Let's move away from the existing system and let's replace it with something else. But they have struggled to kind of identify a consensus plan of what they want to move to next. And so as the president runs for re-election and healthcare becomes salient, one question is whether we will get more of a sense of what his vision is for healthcare that he's running on. On the Democratic side, one of the reasons I think it's been so salient in the primary is you have a lot of disagreement among Democrats, even when they have alignment over goals. So even though different Democratic candidates may both be sort of pitching themselves as a movement towards greater universal coverage or some other generally aligned goal, there have been big discussions about what should be the appropriate state role in the provision of healthcare, and are we building, incrementally making the existing system better, or do we need something more radical? So depending on who emerges from the Democratic primary, I think there'll probably be a strong contrast between this notion of repeal and replace with something else that feels more market-based versus a Democratic notion of moving towards greater universal access and potentially a stronger role for the federal government in meeting those goals.
Joe, do you have any thoughts on sort of the rankings that the audience had for these issues?
I also think that it makes sense. The outbreak is going to both focus people on healthcare, and in its economic consequences is going to quite possibly have people concerned about the availability of jobs. On healthcare, I think Devin's right. This administration is like the cat that jumped up on the hot stove. They probably don't want to go there again. They may very well be talking about, again, repeal and replace with something much better, and this time we'll figure out what that is, but I would not want to be the person trying to make that argument. On the Democratic side, you do have the possibility of pledging that you're going to come up with something better. There's this relatively simple answer, which is the so-called public option, which sounds good to a lot of people. At CED, we have our doubts. We have our own vision, which is empowering people to choose among private healthcare plans that compete with one another, like the model of the Federal Employees Health Benefits Plan, or a number of employers who give individuals choices. We think that choices are a good thing. Different people like their health care delivered in different ways. Some people want to pay more to have a lot of choice. Other people would like to pay a lower premium to go into a health maintenance organization or a relatively narrow network where people are working together as teams. There are different approaches to take here, and we do need a robust discussion because healthcare is expensive and it's not getting any cheaper.
Well, I know that we have some actual materials that you two have put together to sort of walk us through some of these hot button issues. I think maybe we got a little bit ahead of ourselves and sort of already jumping into healthcare. But maybe I'll hand it over to the two of you to run through some of your materials, and Autumn and I will go ahead and step back for a little bit and maybe offer some comments as you basically share with us what you think is on the horizon.
Yes, I think
sure,
healthcare. Go ahead, Joe.
This is a chart that gives you a picture of what's been happening to healthcare costs, and you're looking back over more than half a century. But the point here is this is the part of consumer spending and the part of the federal budget that is growing most rapidly. And this tells you a real story about how those costs are spread. We're reliant on insurance and particularly private insurance, but if you look at Medicare and Medicaid together, that's essentially the federal government share of costs. That's actually growing faster than the private insurance part. Devin, how about your reactions?
No, I think it's right. I mean, I think the real picture here is that private and public have both been growing extensively and steadily. And so as it's become a bigger part of the economy, it's just a more salient issue economically, as well as, the underlying health piece of it, too. So it is one of these sort of double-barreled issues that's really hard to get away from. And when you ask voters, what are they interested in or what is most salient to them, I mean, healthcare has routinely been at the top of that list for a number of cycles now. And I expect that until we feel like we've reached some kind of other place, I think you're going to continue to see sort of agitation and voter interest.
So if healthcare is one of these issues, one of the biggest ones according to our audience, what's another topic that you think is going to be pretty heavily discussed moving forward?
So if we advance to the next slide. So I think trade is one where you could potentially see a lot of conversations in the general election. in part because the current administration has really defined themselves both in running for election in 2016 and then in their subsequent executive administration on a somewhat different approach to trade than we've seen from previous administrations. The president ran as a little bit skeptical of the benefits of trade as they had shaken out, and this shows the increase in exports and imports, but also the period of the 2000s that brought a really large imbalance perhaps between exports and imports in our trade conduct. And so he ran skeptical of that, wanting to close that, skeptical of multilateral action on the trade front. He withdrew from the TPP, the Trans-Pacific Partnership arrangement, which was a multilateral trade deal with a number of Asian adjacent nations. And then his use of tariffs and his renegotiation of some existing trade deals to try to get what he felt was a better deal for Americans out of trade has really been a feature part of his administration. So on the Democratic side, there is a lot of disagreement, I think, on what exactly the path forward on trade looks like. And you see people who kind of echo, in some extent, the president's concerns and skepticisms about whether American workers are benefiting from trade. But you also have folks who are running who look a little bit more like, or are making more of the traditional pro-trade argument for how it helps the economy and the need for some of these multilateral institutions and these multilateral agreements to help the U.S. In the world. So that could be a major point of a difference between the two candidates when we get to a general
election. Joe, I had a question for you. Something that we hear fairly often is that, regardless of the outcome of the 2016 election, whether it was Hillary Clinton or Donald Trump, we would have seen an escalation in U.S.-China trade frictions regardless. Of course, the way that they have manifested themselves would have been unique to each candidate. But what about next year, 2021? If we see the White House flip over to the blue side, will we see the same patterns and the same tactics used moving forward?
There are a couple different perspectives on this question that I think are useful. One, in history, Bill Clinton helped to get NAFTA ratified. In 2016, candidate Hillary Clinton stepped away from the Trans-Pacific Partnership as a strategy. Now, of course, the Trans-Pacific Partnership was supposed to be a unification of China's trading partners so that they could stand up to China. Now we've pulled back from the Trans-Pacific Partnership, which makes us somewhat weaker in that respect. But the troublesome point here is there are substantive concerns about China's trade behavior. The question is, between the two sides, how will they address dealing with China? The current administration has decided to take China on one-on-one. One might think that it would be an alternative strategy that might be worth considering to try to get our allies together so that we could deal with China's bad behaviors, which really extend to all of their trading partners. We could take them on as a group and make it more costly for China to engage in cyber theft, extortion of intellectual property, resistance to investment and entering China's market, and so on. So there are real questions of strategy here, but both sides in the U.S. Contest, Democratic and Republican, do seem to be, to some extent, hostile to trade and definitely hostile to China and its trading.
So no structural change necessarily in the way that the U.S. approaches China, regardless of the outcome of the elections. That's interesting, and I think it's something that we think here in New York and also our team in Beijing as well. What besides trade? Why don't we talk about taxes? I know that was another issue that the two of you wanted to cover.
Yeah, and it's interesting on taxes and on the poll that you put earlier. A few folks said taxes and a few folks said inequality. And in part of the narrative that you're hearing around taxes. Those two things are sometimes joined together. But I think here, too, there's a real contrast that will be drawn out in the general election. The Trump administration, I think, will point to changes in tax laws that they got enacted in 2017 as a major accomplishment of his first term. And they've signaled that they would like to have a round two or a second bite at tax cuts if reelected. They'd like to cut taxes further. On the Democratic side, you've seen some opposition both to the nature and direction of the tax cuts, but also, with proposals for increased spending, oftentimes the Democratic candidates are put into a position of saying how they will raise revenues to pay for all of their spending plans. And so you also get a sense of, what would their approach to tax policy be as a consequence of their interest in putting forward new social spending or more investment. And so there's been a very large and heated set of conversations around what the best approach to taxes is, but they almost uniformly focus on how would you tax the wealthy or higher income folks differently from how we do it now. And so there's been a lot of intramural scrimmaging on the Democratic side about how much revenue can you extract or should you be trying to extract from higher income individuals or higher wealth individuals. And that's really formed a lot of the conversations that have been happening. And so these debates about, wealth taxes and moving to market capital gains tax reforms and these various things, I think originate in part from those two strands. One, a notion about inequality, and then two, a sense of if you've got to do revenues, then where will you go from them? And obviously the Democrats have laid a marker on getting more revenues from high-income people.
Joe, any?
That's definitely, that's a live issue. It's very important. One of the things that I think we need to think about when people say, well, I've got a method to pay for my program, keep in mind that right now the U.S. public debt is growing faster than our economy. Projections currently say that current course and speed, 10 years from now, we are going to have the highest debt burden relative to the size of our economy since the very highest in U.S. history at the end of World War II. So paying for your spending proposals arguably is not good enough. If we carry that kind of debt going forward, and some people say, well, interest rates are lower, so we can carry more debt. Right now, we're pricing that debt at interest rates that are approximately at zero. They can't go any lower than that. There's only one way for them to go, and interest rates at some point in the future will change. So we've got some important decisions to make. The possibility of raising revenues is not unlimited. People talked about a wealth tax. The lowest wealth tax rate that I saw discussed among the candidates who were advocating a wealth tax was 2%. Right now, the interest yield on a 10-year Treasury bond is 0.5%. So if a wealthy person buys a U.S. Treasury 10-year note, that person is going to be paying more wealth tax than the yield on that note. Obviously, we've got some questions to ask ourselves about policy going forward, and it has to reflect, those questions have to reflect what is happening to our public debt.
I actually have a question on the debt issue because we hear a lot about concerns about corporate debt, right? So here you're looking at, you're thinking about public debt, the debt government holds, but there is a lot of concern about how much debt that corporations are holding too. And in an environment where corporate profits are not really expanding and maybe are coming under pressure, so those two, I guess, sources of debt, are they competing with each other? Is it going to make it harder for businesses to find financing if government debt is going up? What's your take on that?
Well, they always do compete to some extent. In good times, we have yield differentials. You expect that a highly rated corporate bond is going to be a certain number of basis points of yield higher than a comparable maturity Treasury, and so forth. What's going on right now is that people are looking very closely at the perceived risk of that corporate debt. So at one and the same time, Treasury yields are going down and yield spreads on risky corporate bonds are going up. And so the margin between the two is getting to be extremely large. That's part of the kind of tail risk that Devin was discussing earlier, the possibility that some of that corporate debt is going to turn out to be unreliable. So we've got some real questions to ask there, and the lesson right now, Ottoman, really is that panic in the markets and a strong flight to quality is not good for people who want to borrow with some risk to their securities and are hoping that they can finance business activities that are a little speculative in this environment.
Hey, Joe, Devin, we only have just 2 or 3 minutes left. I know we've talked about healthcare, we've talked about trade, we've talked about taxes, we've talked about debt. Are there, quickly, in just 1 or 2 minutes, are there any other issues that you want to touch on before we have to close out the program?
I'd actually make a pitch, if you want to move one more slide, I'd make a pitch for one almost thematic issue, which is that I think the trustees at CED have these are all important issues that are coming through in the election. They're all of great importance and immediate importance, and some of them are even of long-run importance. And I think CED and its trustees are in the process of trying to make the case that the national election probably should be focused a little bit more than it is on the long-run future. And so CED has obviously spent a lot of time looking at the issue of how to sustain capitalism, how to make sure that everyone is bought in capitalism's future and preserving it for the next generation. And that means making sure that everyone is benefiting from growing prosperity and that American global leadership in an economic sense is preserved. And so over the course of the next months, we're in the process of releasing a series of papers, a total of 9, aimed at issues that we think are of very high importance in the election and the types of things that candidates, at national office, whether the presidency, Congress, should be dealing with and addressing and coming up with solutions to. And we offer our own sort of approach, what we recommend as the path forward to gearing the U.S. towards long-run success on this issue and a sustainable capitalism. But we would certainly encourage anyone watching the webcast who's interested to go to the link provided in the presentation or to CED.org and checking out these issue briefs as they're released between now and June, and we try to push the conversation towards the long-run interests.
Well, that's a fantastic plug, Devin. And I would like to add, with 9 papers, I think maybe we will have you back sometime over the next couple of months. There's a lot of material to go through, and we won't spend so much time talking about the U.S. economy. So you'll have more time to focus on some of the vast treasure trove, it sounds, of insights and recommendations. But we are at the top of the hour now, so we're going to close out. Make sure to join us every Wednesday, second Wednesday of every month for the Economy Watch webcast. Next month, I'll be joined by Bart Van Ark and possibly a few other as well to talk about COVID-19's impact on the global economy, not just the U.S. economy. We touched on China a little bit today, but we really spent the most of our time talking about the U.S. So we'll have a much broader perspective with Bard and a few other guests this time next month. That having been said, thanks for joining us. Stay safe, wash your hands, and we'll see you in 1 month's time. Thank you.